Have you ever walked past one of those giant gleaming skyscrapers and just thought, man, what would it be like to own a piece of that? Well, today we're going to pull back the curtain on the one investment that makes that a reality, REITs. We are going to break down exactly what they are, how they work, and most importantly, whether they're the right move for you.
I mean, let's just be real for a second. You see a massive office building, a sprawling shopping mall, maybe even a hospital, and you think, wow, I wish I could get in on that action. But for most of us, that just feels totally out of reach, right? Kind of like a pipe dream. Well, guess what? It's not a pipe dream. You absolutely can. And the key to unlocking that door is something called a REIT. Think of it as your ticket to the big leagues of real estate investing, no multi-million-dollar down payment required.
Okay, so let's really get into the big idea here. How in the world do these things, REITs, manage to tear down those huge barriers and open up commercial real estate investing for literally everyone?
So, at its absolute core, a REIT is just a company that owns, operates, or finances real estate that makes money. You know, income-producing properties. The easiest way to wrap your head around it, it's basically a mutual fund. But instead of owning a basket of different stocks, you're buying into a whole portfolio of properties. We're talking apartment buildings, warehouses, you name it.
And trust me, we're not just talking about boring old office buildings. The universe of REITs is way more diverse than you'd think. So let's take a quick tour, shall we? You'll be surprised at what you can actually invest in.
For starters, you've got your retail REITs. They own the malls and shopping centers. Then there are residential REITs, which own huge apartment complexes. You can even get super specific with healthcare REITs that own hospitals and nursing homes. And then there's a completely different beast called a mortgage REIT. Now, these guys don't own the actual buildings. Instead, they invest in the mortgages, the loans, on the properties. So they're making their money from the interest payments. And just so you know, this isn't some tiny niche corner of the stock market. Not at all. I mean, just to give you a sense of the scale here, in the US alone, there are dozens and dozens of these publicly traded REITs in just the retail and mortgage sectors. This is a huge, mature industry with a ton of options for you as an investor.
Okay, so we've covered what they are and how many different kinds there are, but if we really want to know if a REIT is a good investment, we have to pop the hood and look at the engine. And you can't just use your normal stock analysis tools here. No, REITs speak their own financial language.
First things first, let's talk about the main event, the reason so many people love these things, dividends. And here is the magic number you need to remember, 90%. That's right. By law, REITs have to pay out at least 90% of their taxable income back to shareholders, like you and me. This one rule is what makes them such potential powerhouses for generating income.
Now that huge payout sounds amazing, right? But it also brings up a really important question. If they're sending almost all their profit out the door, how do you actually figure out if the company is healthy? How do you know if they can keep making those payments?
And this, my friends, is where it gets a little bit weird. Your standard financial metrics like net income can be super misleading when you're looking at REITs. And the big culprit is something called depreciation. It's an accounting thing. As this Reddit user points out, an accountant spreadsheet might say a building is worth 0. But in the real world, it could be a billion-dollar property in a prime location. That accounting rule just completely distorts the real financial picture.
So to fix this, the industry came up with its own special metric, Funds from Operations, or FFO for short. Just think of it like putting on a pair of special glasses that lets you see a REIT's true earning power. It takes the regular net income, and then, this is the key part, it adds back all that weird accounting depreciation. What you're left with is a much, much clearer view of the actual cash the business is making from renting out its properties.
But wait, we can get even more precise. Say hello to AFFO, or Adjusted Funds from Operations. This takes it one step further. It starts with that FFO number we just talked about, but then it subtracts the money they actually had to spend to maintain the properties. You know, the real-world costs like fixing the roof or putting in a new air conditioning system. The stuff you have to do to keep the business running.
So here's the bottom line, and if you take away one technical thing from this, let it be this. FFO shows you the cash flow the business is generating, but AFFO shows you the cash that's actually left over for the shareholders after all the bills are paid. And that's why the really smart investors look at AFFO. It's the best indicator of whether a REIT can actually keep those dividend checks coming and maybe, just maybe, make them even bigger over time.
All right, we've talked about the good stuff, the appeal, the special metrics. But let's be honest, it's not always a walk in the park. We have to take a hard look at the challenges and the risks, especially with everything going on in the economy right now.
And that brings us to a big old reality check. You know, this comment from an investor online really just says it all, doesn't it? It's a pretty blunt warning that captures the mood out there right now. There's this tension between that long-term potential and some very, very real short-term dangers.
So let's break down what these dangers, these headwinds actually are, and you'll see they're all kind of connected. When interest rates go up, it costs REITs more to borrow money, and that immediately eats into their profits. At the exact same time, if the economy starts to slow down, businesses might close, people might move out, and suddenly their rental income drops. It can be a perfect storm where their costs are going up right as their income is going down.
And one last thing, a really crucial detail for your bank account, taxes. Those big, juicy dividends we talked about, well, they usually come with a catch. Unlike the dividends you get from most regular stocks, REIT dividends are typically taxed at your ordinary income rate. And for most people, that's a higher tax rate, which means Uncle Sam could be taking a bigger slice of your returns.
So, we've looked at the good, the bad, and the technical stuff. Now let's put it all together. Let's turn all this information into an actual plan. Here's a simple blueprint for how you could get started.
You know, getting started is probably easier than you think. First, you just need a regular brokerage account. Then comes the big decision. Do you want to try and pick individual REIT stocks yourself? That means you're doing a lot of research. Or do you want to instantly diversify by buying a REIT ETF or mutual fund, which holds dozens of them all in one package? After that, it's just a matter of doing your homework and keeping an eye on how your investments are doing.
Okay, let's just boil this whole thing down. Here's the balanced scorecard. The pros: you get those potentially high dividend yields, you get to diversify your portfolio away from just stocks and bonds, and they're super easy to buy and sell. The cons: you've got those higher taxes on the dividends, they can be really sensitive to what interest rates are doing, and you're exposed to the risks of whatever specific properties they own.
And look, despite all those risks we talked about, you have to understand that this is a colossal market. We are talking about a global industry worth more than $2.3 trillion. This is a massive pillar of the entire global investment world, and believe me, it is not going anywhere.
Which really just leaves us with the million-dollar question, doesn't it? In today's economy, are REITs a solid cornerstone for your portfolio, or are they more of a risky high-wire act? You know, the truth is they can be a bit of both. The key, as with anything, is understanding the risks, doing your own research, and deciding if this kind of investment makes sense for your goals. Thanks for taking this deep dive with us.